Good afternoon, ladies and gentlemen, and welcome to our quarterly update for the quarter ended 30 September 2020, where we focus on economic and market updates, local and global, and we hone in on the attribution analysis of our multi-asset portfolios, the CoreShares Wealth Accumulation and Stable Income Fund. This quarter, once again, was dominated by COVID headlines. Globally, COVID cases exceeded 35 million, in contrast with Q2, where they were sitting around 12 million. So certainly a ramp up in COVID cases. On the one hand, this is a negative outlook. However, on the other hand, there is a lot of optimism around the establishment of a COVID-19 vaccine, and a lot of progress has been made by different pharma companies and research hubs globally in terms of the establishment of a vaccine. So some positivity existing around that. Globally, if we look at the economy, rates remain low. US and other developed markets, rates sitting at close to 0% across the world. And a lot of global economies, US included, UK, etc., entering into technical recession territory. What we have seen is, once again, a massive disconnect between real economy and capital markets, where August saw a run in global equities, in direct contrast with the economic out. So the contrast between capital markets and economic data was certainly a story for Q3, but a forward-looking story is US elections coming up on the horizon, and with that will come a certain level of uncertainty and of course volatility, which tends to follow that. What we're already seeing is very divergent views. A, the outcome of the election, and B, even within a particular outcome, a Trump win, for example, we're seeing different views on how that outcome could play. So what we see is a lot of uncertainty. There's certainly no crystal balling happening for the US elections, and that kind of talks to some of our messaging around strategic asset allocations and so forth. In the local market, COVID is also, of course, still dominating headlines. We now exceed over 650,000 cases. But on the positive side, there has been a slowdown in daily cases, where we hit peaks and highs of 10,000 odd cases. We're now sitting down at around 1,000 recorded cases a day. So with that, we've seen the slackening and the reduction of restrictions in terms of some of the lockdown restrictions, and so the economy beginning to open up with some positive economic data coming out, albeit off an extremely low base based on the opening up of the economy. We have seen the rand strengthen over the last quarter by about 4.2% relative to the US dollar. However, this is on the back end of a year-to-date, net weakening of the rand of around 16.2%. So again, coming off a really low base. However, some positive rand strengthening over the last quarter was welcome. Two MPC events over the last quarter. Only one led to a rate reduction of 25 basis points, where we see the repo sitting at 3.5% and prime lending rate at 7%. So the outlook is one of low interest rates, opening up of the economy. I suppose one would contrast that with the potential of a second wave and increasing of COVID cases, which would be negative. But generally, we've had positive news over the last quarter in the South African economy. Again, off a low base and on a relative basis. When we look at our asset class returns and how our portfolios have behaved, the wealth accumulation portfolio marginally up over the last quarter. This benign return environment is in stark contrast of Q1 and Q2, when we saw huge sell-offs and then huge recoveries. But I'm going to hone in into a few of the asset classes here and chat about them. The standout winner here was global equities, which contributed the most return to the portfolio, a healthy exposure of 22.5%. Combined with relatively good returns of 3.5%. This in rands, so on the back of rand strengthening, to have positive global equity returns means the equity markets really did run in the global market. Local equities were benign, relatively flat, so not a huge contributor to return, but the largest detractor from returns being local. Still very negative outlooks on the local property markets. a lot of bad distribution news in terms of distribution outlooks coming out of our local REITs. A lot of extremely high loan to value ratios in the market, and in fact, even more fundamentally, a lot of question marks around the REIT status of a number of REIT companies. This contrasted with the potential structural changes in sectors like office and so forth. So, local property, certainly the asset class that's taken the biggest beating in over the year and certainly over the last few years, continues to do so. So, really sitting at massively sold off levels, and this on the backdrop of some really negative fundamental underpins at the moment in the property markets. So that being the largest detractor in returns. The rest of the asset classes at a fund level didn't have large impacts. If we look to our stable income fund, slightly different picture. Property playing a similar role, the same kind of role when we look at how it detracted from returns. Global equity adding positively returns, but local credit in the stable income fund being the largest contributor to returns when we look at an attribution level. Local credit spreads tightening up and rewarding investors in our short-term credit bucket or allocation. So again, a marginally negative return for stable income, a relatively benign return environment over this quarter compared to Q2 and Q1, where we saw significant moves over those quarters. As per usual, we want to drill home one message about these funds, which we believe is important. We're talking about the importance of diversification and the importance of having the appropriate amounts of risk assets and growth and defensive assets in one's portfolio. So what we've done is take a snapshot of asset class calendar year returns from 2003 to 2019. And what we're showing here is how confusing it really is. Asset class returns all over the show. There's certainly not a clear pattern of which asset class will be the winner on a calendar year basis if we look at a picture like this. Zoom out and look at asset allocation and look at the two big levers that we pull on in asset allocation being primarily risk assets being growth assets, property and equity, and then defensive assets being cash and bonds. Primarily, if we split these assets into these two categories over a short-term time horizon, we can see there's still a lot of uncertainty. We can see defensive assets have their day in the sun where they're the best returning assets, and of course risk assets do as well. So no clear trend. What we wanted to show is the noise in the short term, and then show how when we look at longer term time horizons, we can start combining assets to create more certainty in outcomes. So when we go from 1 year through to 3, 5, 7, and 10, we can see a trend emerging where the risk assets or the growth assets start to rise to the top in a consistent pattern. Defensive assets start to rise to the bottom or start to drop to the bottom. And what this really means is that when we have portfolios, multi-asset portfolios like wealth accumulation, we can start to hold more risky and growth assets in that portfolio and tilt the portfolio towards growth and risky assets. If we're looking at a stable income goal of shorter term and shorter duration, we can see it's not as clear as to which asset we should be holding, risky or defensive. So we start toning down and dialing down the risk asset exposure and including more and more defensive assets, which tend to be more stable in the near term and the short term. What we wanted to look at today was just to remind investors there's a lot of noise, there's a lot of volatility in the markets at the moment, US elections on the horizon, uncertainty in the South African economy and political scene as per usual. Let's not incorporate guesswork into our investment process. Let's look at how through time we can create predictability, and over long periods of time we can create asset allocations and solutions that will help achieve clients achieve their goals. So thank you for your time. We appreciate you joining on this quarterly update, and we look forward to the next one. Until next time, thank you.